So 2025 is nothing short of exciting. In fact, I think the term excitement is an understatement because it doesn't fully encapsulate the range of emotions investors actually felt in the first 4 months of the year. And as a tradition on this channel, I do share my portfolio from time to time and I disclose individual position gains and losses. And accurate as of 21st of Feb, you can see that we were indulging in a portfolio of greens. And just 2 weeks after, most of these gains have evaporated even after months and years of accumulation. In fact, the running theme at the start of April was this new great tariff plan that's going to cause a huge recession in the US economy. And just in less than 1 month time, it seems like we are back into recovery phase again. So which begs the question, is the worst over? What are the implications to our portfolio of companies? And ultimately, how would the earnings be impacted? So as the title of this video would probably suggest, I'm going to focus on the most recent Q1 earnings reported by 3 of the 4 Mag 7 stocks that I own in this portfolio, namely Amazon, Google and Meta, and to also triangulate some of these data points and commentaries coming out from the management team on how they foresee the Trump tariff impact. And of course, if you love such updates, don't forget to help gently tap the like button. If not, let's just start with a few general comments. I think as a shareholder, the earnings across the board held up pretty well, not only for these 3 companies, because I've also took a sneak peek at Microsoft and Apple as well. I think considering many of these tariff and recessionary scares, things are still fine, at least for now. But of course, because everyone knows that these Mag 7 companies are some of the best, highest quality companies, you know they're good, I know they're good. So things are more or less kind of priced in. But of course, with quite a bit of uncertainty due to the daily developments of this great new tariff plan. So the AI and cloud driver remains front and center for many of these big tech names, whether is it from a demand perspective in building out capacity or even in terms of their expected spend in some of these CapEx developments to better improve their search algorithm and whatnot. But across the board, I think we do see some levels of deceleration in growth, but let's also not forget what kind of revenue or profit base that we are coming out from. And I think there's still a very convincing story for them to keep it up long enough to grow alongside at least the industry growth rates with very strong tailwind ahead. So let's first talk about Amazon. I think specific to Amazon's earnings, most investors probably just take a look at some of these high-level numbers, and they do break down some of their revenue growth in some of these key segments, like online stores, physical stores, which encapsulates their first-party business, their third-party seller services, ads, subscription, AWS, and others. So I think for both online and physical store, they're growing roughly 5-6% year on year. Third party has also slowed down to around 6%. Advertising services 18%, subscription 9%, and AWS 17%. But I think if you take a 6-quarter look, you can see that generally, yes, across the board, they've been going down. 8-6%, third party 19-7%, advertising 26-19%, and stuff like that. So I think usually, actually, their third party business tend to grow faster than their first party counterpart. But they've seemed to slow down significantly in this latest quarter, which could or could not be affected by this whole tariff situation, and we'll need to monitor for longer periods, especially with this whole kerfuffle with their China counterparts and how most of them are just middleman sellers. And of course, with third parties slowing down, I think ads will naturally slow down as well. And zooming into Amazon's advertising services, they actually grew 19% in the most recent quarter year on year. And I think it really depends on whether you want to put Microsoft into the mix in terms of advertising growth comparison. But if not, Amazon's ads actually grew from strength to strength at the highest growth rate compared to their Meta and Google counterpart. Now, I understand that many of you are probably worried about the tariff situation because Amazon is probably quite closely linked with some of these Chinese merchants. And this is what Andy Jassy had to share. Obviously, none of us knows exactly where tariffs will settle or when. We haven't seen any much impact on demand yet. To some extent, we have already seen some heightened buying in certain categories that may indicate stocking up in advance. So we also have not seen the average selling prices of retail items appreciably go up yet. So Amazon is also not uniquely susceptible to tariffs. So as it relates to China, retailers who aren't buying directly from China are typically buying from companies who themselves are buying from China and then marking these items up, rebranding and selling to the US customers. So these retailers are buying the product at a higher price than the Chinese sellers selling directly to US consumers in the marketplace. So the total tariff will be higher for these retailers than for the China direct sellers on the Amazon platform. So finally, when there are uncertain environments, customers tend to choose the providers they trust most. So long story short, this is my interpretation of what Andy has to say. So there's no slowdown in demand yet. Prices haven't gone up yet. Most of these sellers probably have pre-bought their goods, and most are adopting a wait-and-see approach. So Amazon is not uniquely exposed to tariff risks. And in fact, they are kind of protected because most Chinese sellers sell direct via Amazon, skipping the middleman. And Amazon would like to emphasize that they sell many basic supplies too, which makes them rather resilient even in a down cycle. So crazy times actually favor trusted players, and they expect this time to be no different. And clearly, we all know who is the quote-unquote trusted player here. So now, moving on to AWS, you can see that this is the growth curve for AWS in yellow, Microsoft Azure in blue, and Google Cloud in green. So in the last 2 to 3 quarters, we can see some sort of a slowdown for both Google Cloud and AWS. But Microsoft Azure seems to continue ticking up even in the latest quarter. I'm not too sure how much of it can be attributed to OpenAI's recent increase in data load, but I think that's besides the point. So in terms of their operating margin, AWS has hit a record high operating margin of near 40%. And I think this speaks volumes in terms of the executional capabilities of the team over at AWS, in terms of their size, scaling, and just the entire network effect, and of course, cost and operational efficiency. And AWS might very much telegraph where Google Cloud or even Microsoft Azure can aspire to reach in the longer term. And this part of the business in general, superb quality, great execution, and just the crown jewel of the entire Amazon business itself. So on the AI segment of AWS, our AI business has a multi-billion-dollar annual revenue run rate, and it continues to grow triple-digit year-over-year percentages. While there's a good reason for high optimism about AI, I conclude my AWS comments with the reminder that there's still so much on-premises infrastructure yet to be moved to cloud. And infrastructure modernization is much less actually to talk about the AI. If a company is to realize the full potential of AI, they are going to need their infrastructure and data in the cloud. And as fast as we can actually put the capacity in, it's being consumed. So I think we could be helping more customers and driving more revenue for their businesses if we had more capacity. Basically, I'm talking about supply constraints here. And I will tell you that everything I just mentioned, what's interesting in AI is that we still haven't gotten to all the other customer experiences that are going to be reinvented and all the other agents that are going to be built. They are going to take the role of a lot of different functions today. And even though we have a lot of combined inference in those areas, I would say we're not even at the second strike of the first batter in the first inning. It is so early right now. And if I can summarize what Andy Jassy has to say, just trust me that AI still has a long runway ahead, and Amazon is firing on all cylinders with AWS and any potential expansion opportunity. We are building, baby. So in terms of guidance, net sales are expected to grow between 7 to 11% compared to the second quarter of 2024, and operating income is expected to be between 13 to 17.5 billion compared to the 14.7 in the second quarter. And of course, with all these tariff talks, I think Amazon is still giving pretty okay guidance. A pretty stark contrast to some of these naysayers who are saying that Amazon is going to be badly hit by some of these protectionist measures instituted by the Trump tariff plan. Now, moving on to the earnings of Meta Platforms, I think I can summarize it in 4 words. Don't bet against Zuckerberg, and thank you for coming to my presentation. But to give you a better appreciation in how Zuckerberg has been executing and how Meta as a company is just spectacular and being phenomenal, just looking at the Q1 of the last 3 years, total revenue went from 28.6 to 36.4 to 42 billion in 1 quarter. And operating margins went from 25% to 38% to 41%. And no doubt, that's why you see the share price just appreciating so strongly, because they're clearly firing on all cylinders. And you can even just ignore this line item from the Reality Labs operating loss. Nobody cares anymore, because even with this huge hole that is burning shareholders' capital, they're still growing revenue strongly, operating margins are improving from strength to strength, And there's really nothing much to complain about Meta's execution, at least from a financial standpoint. And looking at their expenses as a percentage of revenue, you have growing strong top line and you have expenses being kept under control from 2023 to 2024 and then to 2025. But of course, the trade-off here is that they are all hands on deck. Everybody is looking at building out the next AI infrastructure and having more compute and more capacity. And that's why their capital expenditure has ballooned to more than 2x from 2024 to 2025, from 6.7 to 13.7 billion. And that's why when reflecting this capital expenditure to their free cash flow profile, even though cash from operating activities have increased from 19 to 24 billion, free cash flow actually dropped from 12.5 to 10.3 because the capital expenditure has more than doubled. So I think this is just a trade-off. Ultimately, we are all just looking for a healthy return on investment and not just blowing our capital into things like Reality Labs, for example. But if it's really into building out their AI infrastructure, which can be translated to more revenue and more profit margin down the line, I think investors will be more than happy for you to blow hundreds of billions of dollars. And I think just something interesting that I wanted to flag out was that ad impressions delivered year on year increased by 5% on a worldwide basis, while at the same time, average prices per ad increased by 10% year on year. So I know that some of you who have been following Meta, especially during the dark times, when things were slowing down, there were recessionary scares, advertisers were pulling back their spending. One very big so-called underhanded quote-unquote strategy was Meta tried to compensate the decrease in ad spend by pumping up the ad impression. So I remember back then there were times where ad prices were down by 9% year on year, but they just bumped up the ad impression by 9%. That's why they kind of offset each other and there were not much growth ahead. So that has a very big concern because we know that if you keep jacking up ad impressions, it will affect the user experience on the family of apps platform. But I think for now, everything seems to be going in the right direction, at least in Q1 of 2025, despite whatever headlines that you're reading on mainstream media, people are still willing to spend. And there were big concerns about some of this Chinese e-commerce player like Shein and Temu bringing down because they are no longer bidding for some of these top spots. But I think all things considered, I think Meta is pretty jacked. They're keeping costs under control. They're keeping things tight. And there don't seem to be a greater competitor coming in to steal a lot of the attention and market share. And I'm not too sure what's going on with the whole TikTok US ban thing, but I think we'll keep our eyes peeled. For now, things is moving in or treading in the right direction, and investors cannot be happier with this set of numbers. So from the earnings call, I think there was a lot of emphasis in terms of how AI is impacting the core engine and the core business. So AI-powered ad engine is actually delivering. So they introduced their GEM model, which is their generative ads recommendation model for ads ranking. So it's twice as efficient at improving ad performance. There's a 5% increase in ad conversion on their Facebook Reels, and 30% more advertisers are currently using AI creative tools in the last quarter. And to basically justify many of this huge AI expenditure back into the core business, they are saying that they are seeing a more engaging experience in the last 6 months. There's a 7% increase in time spent on Facebook, 6% increase on Instagram, and 35% on Threads. And Threads now has more than 350 million active users. And after front-loading you with many of these good data points, they're saying that they're raising again their 2025 capital expenditure to 64 to 72 billion, up from the 60 to 65 billion previously guided, to support their AI and data center scale up. And they're running out of compute. So even with the added capacity, demand still exceeds supply. Reality Labs continue burning money, but AI glasses seems to show some sort of promise. I think Q1 Reality Labs revenue was down 6% year on year, but the Ray-Ban Meta AI glasses partnership actually tripled in sales and 4x in terms of monthly active users growth. So by the third generation iteration, I think Zuckerberg is looking at roughly a 10 million unit as a ballpark short-term goal in terms of sales numbers that is his kind of his short-term KPI. And like I alluded, some of you might be concerned about some of these Chinese spenders. So specifically, we have seen some reduced spend in the US from some of these Asia-based e-commerce exporters, which we believe is in anticipation of the exemption going away on May the 2nd. And a portion of their spend has been redirected to other markets. But overall spend for those advertisers is below the levels prior to April. And we generally saw healthy growth in most verticals in Q1, and we did see some weakness in gaming and politics. So year-over-year growth in gaming was negative in Q1 as we lapped a period of strong spend from China-based advertisers that were promoting a larger volume of game titles in Q1 of 2024. So I think a larger thing that you have to take note of here is that yes, probably selling into the US after this whole Trump tariff plan might be a little bit more challenging, but that said, it does not mean that Facebook has no more business, or in fact the family of apps on Meta platforms, because they do advertise to the world, and it has been a great enabler in driving cold traffic to some of these large merchants. Sure enough, you can say that the advertising revenue targeting US consumers is a lot more worthwhile and a lot more profitable compared to the rest of the world. But also don't forget that the entire advertising model at the back end is a bidding model. So maybe Shein, Temu is out of the picture moving out in the next few quarters, but there will be other advertisers that will step up their spend. But in this case, I think the two bigger concern is that one, if there's a general slowdown and all advertisers pull back their spending, then the overall ad spend will decrease, and this will impact both top line growth and bottom line numbers. And secondly, is of course if there is a greater competitor that is able to steal more mind share and more attention away, then they can start diversifying their advertising revenue. That's when Meta will be hit pretty significantly. But now, if we're just looking at the macro cyclical concerns, I'm not too concerned, at least in the near-term horizon. Just by looking at how things are setting up for Meta, also from the confidence, from the commentary coming from the management team itself. Lastly, we have Alphabet, which is the parent company of Google. So they grew their revenue top line by 12% year on year, and their operating margins has continued to improve to 34%. So cost of revenue is up 8% year on year, while operating expenses are up 9% year on year. And these two actually grew less than the top line revenue growth of 12%. So that's good, pretty good cost control. So looking at the breakdown of their revenue, search continued to grow 10% year on year. And contrary to popular belief on what you like to look on Twitter or YouTube, a lot of people are saying that search is dead, but clearly it's not. YouTube ads also grew 10% year on year, but their Google network is down 2% and subscription is up 19% year on year. Operating margins has also steadily improved to 42.3% in the first quarter of 2025. And if we pivot over to Google Cloud, cloud revenue growth rate grew 28% year on year. Operating margins have improved significantly to 18%. But capital expenditure, I think across the board for many of these hyperscalers, they're just pumping billions and billions of dollars. Right now, they're sitting at $17.2 billion in the first quarter of 2025, and that's a 43% year-on-year growth rate. Now, in terms of what's important in the earnings call, I think Sundar actually did say that in search, we saw continued double-digit revenue growth. I think AI overviews is going very well with over 1.5 billion users per month, and they're excited for the early positive reaction to their AI mode. In subscriptions, we have also surpassed 270 million paid subscription with YouTube and Google One as key drivers. And cloud actually grew rapidly with significant demand for their solutions. They are also planning to invest approximately 75 billion in capex this year. Recall, I've also stated on the Q4 call that we exited the year in cloud specifically with more customers demanding that we had capacity. And that was the case for this quarter as well. Again, talking about supply constraint. And just trying to triangulate some of these data points coming out from some of the most important people running some of the most important businesses in the world. I'm talking about how they're supply constrained and how they're pledging X billions of dollars into building up their supply because demand is just exceptional. Probably will give you some sort of an optimism in terms of what we can expect to come, at least in this whole cloud and AI space. So YouTube Music and Premium actually reached over 125 million subscribers. And finally, Waymo is now safely serving over 250,000 paid passengers trip per week. And that's up 5x from a year ago. And they also gave examples of success use cases of demand gen and performance max campaigns where the integration resulted in a 2.7x higher conversion rate and a 70% lower cost per acquisition for purchasers. Basically, giving you some sort of a testimonial to tell you that, trust me, I know what I'm investing in. My AI and a lot of my models at the back end is working and it's serving customers well. To also plausibly justify their AI capex spend. So I think a lot of all these things are trending in the right direction. But I think for Alphabet specifically, there's a very big elephant in the room, which is Google search. So actually I've spent some time looking at this whole search argument and many of these convincing bear theses or antithesis around Google today. So I'll probably dedicate a separate video talking about Google specifically. And for those of you who are interested, remember to subscribe to this channel so they'll be notified when the Google video is up. But if not, I think generally speaking, for the three companies, things are still executing pretty well. Not to go too much into the valuations, but if they continue executing at this pace, they'll continue surprising investors to the upside, and they'll probably be a greener pasture ahead. So that's generally how I look at some of their numbers and their earnings today. And with that in mind, for those of you who are also invested in these companies, feel free to share your ideas and comments in the comment section down below. And with that, I'll see you guys in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.